And now I'm going to introduce the presenters for your first buy recommendation. On this team is Pascal Laut, who is originally from Marburg, Germany. Pascal has been on a tennis scholarship at Washburn since 2010. He also found time to take a semester abroad in France. He's majoring in finance and economics, and he already has a summer internship lined up at KPMG. After that, Pascal's plans include graduate school in Europe. He's planning for a career in banking and corporate finance, and his long-range plans include earning a CFA charter. Also on this team is David John Tiemens, known affectionately as DJ, and may I add by everyone on this campus. DJ is just a very well-known Washburn citizen. DJ has earned an undergraduate degree with a dual emphasis in economics and finance from our very own Washburn School of Business, and he is scheduled to complete an MBA this week. DJ is originally a native of Toronto, Canada, and he has been a Sunflower State resident for the past 6 years. DJ says that his best takeaway from APM is that the deepest insights into true value can only be obtained by combining that qualitative and quantitative approach. And so I will turn this over to our first presenters, DJ and Pascal.
Fantastic, thank you. Okay, let's begin. Tonight, Pascal and I are going to be pitching a company that has a PE of 3.09. It has a price to book of 0.9. Moreover, this company is in the Eurozone, and it's in the automotive industry. It is the parent company of Lamborghini, Porsche, Audi. Of course, this company is Volkswagen. They're known as the Volkswagen Group. Now, we know that when we tell you, we give you those numbers, and then we tell you that they're in Europe, and that it's an automotive company, most of you are wondering, wow, this company's either in a lot of trouble or it's seriously undervalued. Pascal and I believe that it's undervalued. Stepping back, our task as analysts is first and foremost finding value for our clients, the Washburn Foundation. Because we only trade once a year, we prefer a relatively low beta stock and a company devoted to long-term growth. Now, Pascal has already studied the automotive industry at length for his economics thesis. So being that our portfolio was so underweighted in industrials, he and I looked for value in this sector. Volkswagen proved to be the best positioned company in this industry for our clients. Upon more investigation, we ultimately pitched VW to the class, realized a 7-to-1 vote in our favor to buy the Volkswagen's group stock. Now here's why. Volkswagen makes 245 models of passenger cars, trucks, buses under 10 different brand names. It has a remarkably low 5-year beta of minus 0.26 and a market capitalization of almost $90 billion US. More importantly, Volkswagen has a strategy. This strategy is simply named Strategy 2018. In a nutshell, this strategy states publicly that Volkswagen intends to be the world's largest seller of motor vehicles by 2018. And here's how they intend to do it. Basically with 4 matrices. They intend to lead in customer satisfaction, have profit before tax margin of 8%, sell more than 10 million units, and become the top employer. Keep this slide in mind because we're going to use this later on in the presentation to evaluate how well they've done. Now, many of you in this audience, I understand, were here for the McDonald's pitch. And the McDonald's pitch, they had a plan to win strategy. Volkswagen is very similar. They make extremely public comments. This was taken out of their last year's 10K from the CEO. And he uses it's very transparent. He says whether or not the company is going to have a downturn, not the company, whether there's a downturn or upturn in the economy, Volkswagen intends to still be the top of the automotive industry by 2018. You'll note that he uses very strong words like promise, and he keeps our shareholders in mind. So, using Porter's 5 forces, starting off with supplier power, we rated this as low. 70% of the suppliers for Volkswagen are in Germany. Spot market prices are decreasing for raw inputs that they need, hence this bodes well. They have strategic alliances, and of course they have this incredibly powerful safeguarding mechanism called the NCA system. This forecasts supplier power issues 2 years into advance. Buyer power, we rate this as medium to high. There's many substitutes, many buyers, medium switching costs. With respect to competitive rivalry, we of course rate this high as there's numerous competitors, many strong brands, and little overall differentiation. Now when we say little overall differentiation, take note that we mean little overall differentiation because they're not selling planes where everyone else is selling cars. Volkswagen literally does have quite a bit of differentiation in the automotive industry. Threat of substitutes, we rate this high as well, simply because there's so many manufacturers. Of course, when it comes to other substitutes like, public transport and everything, we believe that the majority of those threats in Europe have already been realized, and there's little to none in America. Moving on to threat of new entrants, we rate this as low to medium, simply because there's so many high barriers to entry. Volkswagen is a very well-established brand, and of course the economies to scale. Moving internally towards SWOT, we go to strengths. Volkswagen has a strong financial sector. Last year they made $10 billion in their financial services sector in revenue. Last year, for as an example, Ford lost 8.4 and GM only gained 1.5. So we consider that extremely strong. Of course, they have strong loyalty and satisfaction, and they have, one of their greatest strengths is growth and industry diversification, which we will examine a little bit further later on. Weakness, we are aware that they have a large market share in the EU. Moreover, that the automotive industry in the EU is tepid at best. However, Volkswagen is making moves, and we will illustrate that more later on as well. Opportunities, of course, Volkswagen is high R&D, they're moving into emerging markets, and they are making gains from struggling manufacturers and market share. With respect to threats, there is a small threat of startups focusing basically in electric powered cars in Asia and in China. This might not be as much of a threat as we think because of Volkswagen's high R&D. Volkswagen actually literally can make any of its cars within a year an electric car. So as much as it's a threat, it's also an opportunity. Of course, government emission regulations and regulations in China are a concern, and of course the debt crisis. Now we're going to move a little bit more into the quantitative with Pascal.
Thank you, DJ. I'm going to continue with the 3-year CAGR of Volkswagen. And first of all, a couple of things that I would like to point out here is the enormous growth that Volkswagen shows here, especially for the EBIT, NOPAT, earnings per share, and also the EVA, economic value added. Another thing that I would like to point out is the free cash flow. With such a growth for EBIT, NOPAT, earnings per share, and EVA, we would expect to have a larger growth in free cash flow, obviously. But as DJ mentioned, the strategy 2018, Volkswagen has to invest a lot in order to increase and expand, and that is why free cash flow is comparably low. Another point that I would like to point out here is the MVA. Volkswagen has gained economic value, but the MVA doesn't show it yet. The market just hasn't realized the value that Volkswagen has gained economic-wise. Now let's take a look at the revenue per share. Comparing Volkswagen with GM, we can see that Volkswagen has been very efficient in creating value with the use of the shares, and also compared to GM, Volkswagen is much more efficient with the use of the shares. The gross profit margin, again, comparing Volkswagen with GM, we can see that in the production, Volkswagen is much more efficient than GM, and we can also see that Volkswagen has been very stable over the last couple of years, and they're even improving their efficiency. Earnings yield and dividend yield. So here we have to note that on the right side, dividend yield is measured in 10% of the earnings yield on the left side, And what we can see that earnings yield after a recession year in 2009, you will see that throughout the presentation that Volkswagen took a hit in 2009. Earnings yield increased a lot for 2010, 2011, and 2012, which basically just means that the earnings that Volkswagen has gotten over the past couple of years, that the stock price just didn't keep up with the earnings that Volkswagen has generated over the past couple of years. And dividend yield is also relatively low to the earnings yield, which means that Volkswagen is earning a lot more than they are spending on a dividend, which they again use for the strategy 2018. Here the PE ratio, comparing Volkswagen again to GM, we can see that PE ratio is inverse relation of the earnings yield, and we can see that here was from 2009 to 2010, the PE ratio decreased a lot. And right now the PE ratio is about 3.09, which is considerably low, which is even lower than the than GM's PE ratio, which is still in the bailout befuddlement. And this basically can just mean two things: either Volkswagen is in serious trouble, or Volkswagen is just highly undervalued. And we're going to take a look here at the ROA, ROE, and ROIC. Especially the ROIC is a good measure to see whether the PE is justified or not. And we can see again that we have that Volkswagen took a hit in 2009, but besides that, they're just showing great growth. And as an ROIC of over 10% is really good for the industry, which means that the low PE is not justified for Volkswagen. For the ROA and ROE, we can also see a clear uptrend. So now let's take a prediction of the ROIC for the future. What we're gonna expect for the future from Volkswagen is that NOPAT will grow. Obviously, as we mentioned, the 2018 strategy will generate more value for Volkswagen, will generate more profits, and so NOPAT will grow. But what we also think is that total invested capital will decrease, or at least not increase by much, because right now is the moment that Volkswagen is investing, and as a result of that, the ROIC will increase. Comparing the EVA and the MVA, as I was talking about it earlier already, we can see that from 2007 to 2008, the MVA was really high. And compared to the economic value added, we could even say that it was a little bit overpriced. Then in 2009 they hit again, and from then on EVA just recovered and went straight up. We have great growth in an economic measure, but the market just hasn't realized it, which means that the economic value added is not, or is unpriced by the market. Let's do some forecasting here for the income statement. First, for the revenue growth, the average over the past 5 years was 12.1, and one important thing for us was that we are trying to be very conservative here throughout the forecasting, and so we went down from the average of 12.1 to a 5.5 growth for 2013, and then smoothed it down to a 2.5% in the perpetuity. For the gross profit margin, we think that the average of 15.6% is good, because it's even lower than the past couple of years. But we were able to see earlier that Volkswagen is steadily trying to become more efficient, and they have done it so it's again very conservative. The operating margin, as DJ mentioned earlier, Volkswagen has a goal of 8% for the future. But we again try to stay under that with a 5% up to 6% in 2016, and for the perpetuity a 5.5%. With net margin we just try to stay under it, and here we just stayed with 4%, 5%, and again 5% for the perpetuity. Common share growth, we think or expect that the common share growth is a little bit slower than the 3.5% with 1.5%. And dividend growth, we just took the average and smoothed it down to a conservative 2% here. The cost of capital, or the weighted average cost of capital, we have a risk-free rate of 2%. we used a more conservative 5-year beta than the one that DJ mentioned earlier of negative 2.6%. 2.6. We took 0.76, and the market risk premium was 7%. We took the long-term growth from the income statement of 2.5% and smoothed the alternative beta closer to the market of 0.9 and came up with a WACC of 7.9%. The dividend discount model, we basically used the same assumptions that I mentioned earlier. Again, the same expected dividend growth rates and also the 5-year beta as well as the alternative beta. And we came up with an intrinsic value of $92 as of the dividend discount model, which is approximately half of the price of the current price, which is extremely high for a company where we don't expect to gain most of the return from a dividend. And so we can see, even so, we expect the stock to grow. Half of the stock price is backed up by the dividend discount model. Okay. So now the intrinsic valuation model. As of the free cash flow, we calculated them here especially. And we can see that from 2009 on, the stock has always been undervalued drastically. And also for the future years here, from 2013 to 2017, we expect the stock to grow even more, and that with all the very conservative assumptions that I just mentioned. And so we think that is one of the reasons why we think Volkswagen is a great buy at the moment. Here we're comparing the intrinsic value estimates with the current price, and we can see that the current price is undervalued by almost every intrinsic value estimate that we have. Of course, the dividend discount model, as I just mentioned, is lower, and the price to free cash flow is, we don't have it here because of what I mentioned with the free cash flow, that it was negative for a while. But besides that, we can clearly see that Volkswagen is undervalued. Now DJ is
Fantastic.
going to continue. Yep.
Okay, so the future of Volkswagen is growth and diversification, and we touched on some of these issues in the past, so let's clear some of these up. With respect to unit sales, in 2018, in order to get the 10 million unit sales that Volkswagen projects, you'll see that in the red. So that will be Volkswagen, Audi, and all their other divisions. And in 2010, you'll see where they've reached. So in 2010, they reached the sales of 7.2 million units. However, what you'll note is that by 2012, they've already reached 9.2 million units. So in 6 years, they've already almost reached their goal in 6 years in advance. With respect to their diversification, this graph shows 2008, 2012. This is their portfolio weights and their revenues. And I said to you that they were aware of the issue in Germany and the Euro area, and you'll see here they've decreased their portfolio weight by 13% in the European area. However, of note, they've increased their revenues by 32 billion euros. Okay, and most of this, of course, has moved into the Asian Oceania market with a 10.2 increase and a $25 billion euro increase. I mentioned that they were growing market share. Here, you'll note that since the recession, they have continually taken market share away from their competitors, GM and Ford. And I said to make sure you remember this slide and how they intend to do their 2018 strategy, and now we're going to see how well they have actually done to date. With respect to consumer satisfaction, out of 10, in 2007 they started at 8.2, they have moved up to 8.67. Profit before tax from 6 to 13.2. Of course, I've already spoken of the unit sales up to 9.2 million. And their employee satisfaction of a low of 84% has moved to 90%. Of course, with all this talk about growth, what we haven't mentioned is the fact that Volkswagen is still beating the S&P, the measure that we measure, what we measure it by, our portfolio by. Moreover, you'll see that the stock now is a moving upward, and it's beat its 2 moving averages. Hence, we are ultimately convinced that this stock is a buy, and we recommend a limit order on the VW stock. Thank you.
Anybody have any questions about that investment thesis they'd like to ask the students? Great. I'm the moving microphone technician.
So the revenue breakout at the end here is helpful, but what's the profit breakout between the regions? Are they really profitable in Europe, not so much in Asia, so on and so forth, or where does the operating profit happen?
Did you understand it?
It's asking where the majority of the profits are coming from.
Okay, yeah, we had that slide earlier where he was showing the pie chart, the last pie chart. I think you have it also in the report in front of you. Let me see which. It's the page number 4. Here we can see the international diversification of Volkswagen and also comparing it from 2008 to 2012. And we can see on the very right side the percentage of revenue and where it comes from which zone. So we can see that the main is still from Europe and other regions, but it has declined over the past 4 years.
So just to be clear, but where do they earn more money? Like, I know where the revenue is, but are they more profitable in a certain region over the others?
I'm not sure if I quite understand that question, but I think most profitable. I think that's in Europe. Still.
Hi, I'm Kevin Reinecke, and I work in the consumer goods market. And one thing that we really try to measure is inventory. And I noticed that their inventory has doubled over the last 2 years. Now their growth has went up, as well in revenue. Are you concerned about that? Because it looks like their inventory turnover has went down 3 out of the last 4 years, and that can be an indicator that you may be overexposing yourself. I'm just curious if you had any thoughts on the inventory that the company is doing, or is that part of their growth strategy to have the inventory available?
Actually, thanks. That's an awesome question. I actually looked into that in their 10K, and there's jokes in the industry that whenever there's a potential for growth, Volkswagen is there, and they claim that that's one of the reasons why. So they have a high inventory so that they can pursue whatever market they're reaching.
Anyone else? Dennis?
Where's their what changes have they made in their manufacturing locations? Are they building plants in North America, China, South America? I know they've been in South America a long time, but where are they increasing their manufacturing capability?
I know they're building just about everywhere, but India and China are large growth markets for them. They're building there. There's a couple of reasons for that, tariff reasons, other reasons for that, but the majority of their growth, or the majority of their manufacturing parts, is still in Germany. Does that answer your?
Okay, Brian Casebeer with Merrill Lynch. I've got 2 questions. When we looked at the domestic issues we had with GM, et cetera, part of that issue had to do with the amount of models that were being produced. Yep. When I look at Volkswagen, 245 different models, is that something that will impact them positively or negatively in the future? And question number 2 is, you had mentioned that their financing was one of their strengths.
That's right.
Or do they have a government-run bank through Germany, or how is their financing run to make that such a, especially given the debt crisis, how will that impact their financing going forward?
I definitely can't answer number 2. Sorry. Can you, Pascal, at all, with their relationship with banking? I can't speak to.
I have to look a little closer to that.
So with respect to the first question, could you just repeat the first part?
Certainly. With 245 models.
That's right. Okay. So this is for them what they consider a boon. I mean, this is a diversification for them. A lot of people in America, the industry is changing. At one time, Ford would build cars specifically for the North American market and specifically for the European market. This is no longer the case, if that makes sense. Like the Ford Focus that's in Europe is now in North America. All these different vehicles are built for the world market. If there's a need, they consider this actually a strength of theirs, the diversity they have of different models. Okay. Does that? Sure.
I'm Jim Reed with Scout. You've got about 60, looks to me like 60% of your revenue in the Euro area, where a lot of the Euro countries have found out they're kind of stuck with the currency valuation. Now that Abe is going to debase the Japanese yen, have you done any sensitivity analysis or any competitive analysis with the Japanese competitors versus Volkswagen, Toyota in particular?
We haven't done any sensitivity measures, but with the Eurozone, of course, that is a big issue. Also, looking at the to Japan with the depreciation of the currency. But what was really important for us when looking at Volkswagen is that they're furthermore diversifying our portfolio with having such a low beta, and also that Volkswagen is looking for more diversification internationally, which was important for us, and that they're also showing the trend for the future, if that might help to answer your question.
Brandon Hawley, U.S. Bank. Just a couple points of clarification for me personally. On the first page of your report, 12-month target price I have of 0. I don't believe I'll be giving the company away.
Bad data feed from capital.
Okay, perfect, awesome. And then just another point of clarification for me as well. Will you be purchasing the ADR, or the American Depository Receipt for the company? Okay, so all right, because I saw the current price of 180, and I was just doing some checking around, and the ADR is actually trading at 36. So I was just.
So we're taking data from Europe and converting
Okay.
it to U.S. dollars.
Okay, perfect. That's actually all I had, those points of clarification, so thanks. That was easy.
Anyone else? All right, if there's no more questions, let's thank our presenters.